Did you know that many FHA home loans are assumable? Meaning you could literally take over someone else's FHA mortgage with their interest rate, terms, and present balance. In today's market, that's a strategy few buyers explore, but it could save you thousands. Let's dig into how that works and whether it's the right move for you. Stick around because by the end of this video, you'll know exactly how FHA loan assumptions work, what qualifications you'll need, and I'll share a real example of how it can benefit you. Don't forget to subscribe so you don't miss more smart home buying insights that could make a difference. So first, what makes loan assumption possible in the first place? A lot of home buyers hear the phrase assumable FHA loan and think it's a myth or something that rarely applies. But here's the truth. FHA loans are designed to be assumable as long as the buyer can be approved by the lender. When the home's sales price is higher than the existing balance, the buyer may need to cover that difference between the sales price and the FHA loan. That's where good planning and a clear understanding of your financing options becomes so important. Even though the process sounds complex, the potential savings make it absolutely worth exploring. Now let's break down exactly how FHA loan assumptions work. An assumable mortgage lets a buyer take over the seller's existing loan, keeping the same interest rate, balance, and repayment terms. You'll need to meet the lender's credit, income, and debt-to-income requirements. If the home's sales price exceeds the remaining loan balance, you will have to cover that difference between the purchase price and the assumed loan balance, either by paying cash or getting a second mortgage. The benefits? You could lock in a lower interest rate than what's available today. You may also save on closing costs compared to getting a brand new mortgage. But you need to remember that. You'll still need to qualify with the lender. The assumption must be approved before closing, and the seller may be released from liability depending on the agreement. Now let's look at a real-world example to see what this could mean for you. Let's consider Jane. She found a $200,000 home with an FHA mortgage at 3.5%. The home's remaining FHA balance is $150,000, but today's mortgage rates are 6%. Here's what happens. First, she qualifies under lender underwriting. Then, she pays $50,000 cash or uses a second mortgage to cover the difference. That's the gap between the FHA loan balance and the home's selling price. And now, she takes over the FHA loan with its original 3.5% rate. Her monthly payment is far lower than what she'd get on a new loan today, and she saves on interest for years to come. That's the power of assumption when conditions align. So, when should you consider assumption, and how do you move forward smartly and safely? Now, are FHA loans assumable? Yes, absolutely. Well, if you qualify with the lender, then if the seller's FHA loan is in good standing, and if you can cover or finance the difference between the sale price and the FHA loan, then you can assume the existing FHA loan and potentially keep a much lower rate. If you'd like to explore assumable FHA opportunities or just want to understand whether it's the right fit for your goals, go with me at Unlimited Mortgage Lending, backed by over 25 years of experience helping buyers use creative, proven strategies like this. So now tap like, hit subscribe, and turn on notifications so you never miss more homeownership insights like this. And go to getmymtge.com to explore your pre-approval options and see if FHA loan assumption could be your smart next step toward homeownership. Because with the best mortgage broker in Florida, your dream of homeownership is closer than you think.